In this broad discussion with Dinos Iordanou, the Chairman, President and CEO of Arch Capital, we spoke about the impact of the sluggish economy on specialty lines, how new capital is changing reinsurance purchases, evolving industry regulation and more. Here are the highlights.
Well, for professional liability, D&O, workers' compensation, which are long-tail lines, investment income, it's a big component of your returns. And with the lack of investment income, because interest rates are so low, I think it has an effect on the underwriting decisions, meaning that we need more underwriting profit per se to achieve adequate returns on equity, because the investment income side of the business is not going to perform as well as we thought we would. Well, I think the energy risk is fine. There is plenty of capacity, and rates have been stable. Where in the construction, I think as some of that industry is starting to recover a bit, we're seeing more activity in the construction space as customers are starting to see more projects being approved and funded. Rates are starting to stabilize and go up a bit. This is an industry that has suffered from a profitability point of view, and it was double hit, so to speak, because the customers, they were also suffering from lack of work. So the combination of the two put a lot of tension on that industry, but it's starting to slowly recover. Ability now of capital markets capital to be entering the business freely, it is a challenge. It changes the thinking, long-term thinking, because at the end of the day, it creates for more an efficient market. So our instructions to our underwriters is that view of this as permanent capital. It will come into the market. It's another sort of a capital providers, and for that reason you need to behave in a fashion that it will be permanent. It's not something that it will stay with us temporarily, and for that reason you need to adjust your underwriting standards to deal with it. Some people believe that the capital markets capital entering the market will require adequate returns, because the capital markets are always looking for adequate returns. So in the long run, it should not have a significant effect in the profitability of the business. But of course, at the beginning, as is viewed new capital, it does have somewhat of a downward pressure on rates. As you're probably aware, we have entered the space of mortgage insurance. We have made an acquisition which we're in the process of closing for PMI and CMG in the West Coast, and hopefully by year end, that acquisition will be closed, and then starting with 2014, mortgage insurance will be the third leg of the stool, so to speak. We got insurance, we have reinsurance, and then we'll have mortgage insurance. So that's where we're focusing our efforts, and that's where we're looking for growth. Well, regulation is an important part of what we do in the insurance business, and ComFrame is a good idea. I am still skeptical on the basis that unless you get unanimity of thought in the direction that regulation will be applied worldwide, you end up with dual regulation. And until we get that cohesiveness, to give us the benefit of lack of duplication and simplicity, so to speak, the benefits, they're not going to be there. So I still have a lot of concern about having to do the work twice. But once regulators, through the supervisory colleges, they start sharing more information, hopefully, over time, the regulation will become less burdensome and less costly, because at the end of the day, costly regulation affects the consumer, because we have to fund for it, and prices have to reflect also all costs, including the regulatory cost. Rates in the insurance side, they're starting to move up, I think, is the outcome and the recognition that investment income for the foreseeable future, it will be limited, and for that reason we need to have more of an underwriting return in order for us to achieve acceptable ROEs. And I see that stability going on forward. So it's good for the industry and it's good for the customers, because you don't like to have violent reactions with rates either precipitously coming down or rising very rapidly. That's not the best thing for our customers. So I would think that over the next few years we're going to have an improving market, that it will allow us to get adequate ROEs. In the last few years, I think competition was intense, and the ROEs perform on an accident year basis. They were not what we would like to see, but hopefully as rates they're inching up over the next 2 years, 3 years, we will get to an equilibrium that allows us to achieve the adequate ROEs.
We'd like to thank our sponsors and advertisers for their support of RIN TV's coverage of the Rendezvous in Monte Carlo.